I guess that what happened is when I was approached by Wiley to publish the book in the UK and in the US, there were three elements that we had to talk about, no? To add to what Nosotros Mercados had been discussing. The first thing, obviously, was that we were in a bull market. Nosotros los Mercados was published when the world was collapsing, and risk premium was bringing peripheral countries down the drain, and there was a lot of concerns about the breakup of the euro, etc. And it was very much about the things that the Spanish media portrayed as realities of the financial markets, and obviously were not correct. So it was very much about debunking the myths of the financial markets. This English edition, what it tries to do is to go a step further, and it tries to go a step further into what has happened afterwards. In the book I mentioned that in the middle of the crisis, a friend of mine mentioned, a trader mentioned that this crisis was worse than a divorce because he had lost half of his assets but he was still married. And things changed, things changed dramatically. It was a huge financial crisis, a lot of things that were taken for granted, credit, the general economic environment, China growth, US stability, the monetary system, the credit system, a lot of things were questioned. A lot of things were questioned. And then we went from a period of extreme pessimism to euphoria. And suddenly we forgot everything. We forgot everything. It's amazing how, from the publication of a book to its alleged translation, that's why I had to update it, the perception from people has changed dramatically. We've gone from saying we had an issue of excess credit, we had an issue of excess debt, to we can be a bit more in debt. We should borrow some more. We should get further into deficits. Debt is cheap. We've gone from complaining about the financial system, talking about what financial players were doing to countries with borrowing costs and with risk premium, to complacency. And I thought it's a good time to talk about that next step, which is, we talked about the problem, then we invented a solution, and the solution was to cover everything with money. Okay, so it's interesting how I saw that there was a book there where I was waiting that was talking about greed in the financial system. No? And it's interesting how the solution that we collectively decided would be the best to cover that problem is more money. And imagine what a surprise we have all over Europe, for example, when now, after the giant stimulus package that we had in 2008 to 2010, that created those beautiful airports that we have, for example, in Spain, that we have airports that look like the Death Star, and that we don't see anywhere else in the world, and those, high-speed trains and everything. What we think is the solution is more of that, more of that. And in comes Japan, and Japan was like the hope, and at the same time, the disappointment, because everyone said, look, Three Arrows, economics, all these great, the decisions are going to change everything again, and they don't change everything, no. So it's interesting how we've gone from blaming speculators, how we've gone from blaming the financial markets, how we've gone from blaming rating agencies. Nobody talks about rating agencies anymore, the poor guys. They went from being evil guys that wanted to bring down governments and bring down countries to no one cares about rating agencies. And we created these new demigods, which are central banks. And it's interesting how the same instruments, which are financial markets, debt, further deficits, the same instruments that we complained about become the norm of the solution. We only change who's making it. So it's the banks lent too much and went into too much debt. Yet the central bank can multiply by 3 its balance sheet and nothing happens. Isn't it great? But, that suddenly we have this sort of carpet that we can hide things under, That we can hide things under. And what that does, basically, is pretty much, we're in this pretty much the same situation in which we forget about the lessons of the crisis, which were very valuable for all of us. In the book, I talk about how a lot of investors learned to improve their perception of risk, improve the valuation of risk and the assessment of risk, how banks also change their exposure. Think about, for example, we're seeing now oil prices go down a lot. And everybody's talking, wow, the next bubble is energy exposure. And we see suddenly, almost with a shock, that the maximum exposure of banks to energy is about 5-6% of the loan book. So we've learned things. There's been a lot of improvements in the way that we perceive risk. Yet something in the back of our heads wants us to return to 2007. And that is partially the issue that we discuss in the book. How to avoid the trap of both excessive pessimism and at the same time the trap of euphoria. The trap of euphoria is very easy, because the trap of euphoria, you can talk for hours about how economies are better or worse, or how valuations are higher or lower, blah 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 blah, and have a very, very detailed analysis. And then somebody drops by and says, "Yeah, but central banks are printing money," and your entire thesis of whether something is expensive or something is cheap goes down the drain. I read just the other day, I mean, it's only a few years ago since really the financial crisis was sort of curtailed. And only a couple of days ago, I read yet again, traditional valuation metrics don't matter anymore. Traditional valuation metrics don't matter anymore. And that scares me. It scares me because we're back to the new paradigm messages of 2007, 2008, in which the greater fool theory that we discuss in the book was the norm. What is the greater fool theory? The greater fool theory is that I buy something that I know is super expensive, and I say, yeah, but he wants it. But he wants it. He doesn't know that I'm mentioning him, and he definitely doesn't know whether he's interested in buying my asset. Yet you will say, well, if he wants it, I'll buy it from you. I got rid of it. And then he obviously has to say he's interested, yet again. So one of the things that I tried to achieve with the English version of the book was to reassess first all the elements about who's to blame, who's not to blame, are financial speculators evil? Why is a financial speculator evil, yet a government that speculates on GDP growing by 3 or 4% by borrowing 3 times more is not a speculator? Why do we think that generating a tremendous amount of credit in the financial system, creates big bubbles and large systemic risks, yet we don't think that doing the same in the balance sheet of a central bank will have a different outcome. You know, and it's very, very interesting that instead of using those lessons of the financial crisis to look at what's happening globally with the monetary expansion of some of the central banks, with extreme easing policies. I mean, think about this. Think about this. A country that is going to grow 7% lowers interest rates. How crazy is that? No? We're going to grow 7%, but we're lower interest rates. Why do we lower interest rates? You know? But we find it normal. No? A country that had as an objective to reduce unemployment below 6.5%, reaches below 6% and grows at 3%, yet is afraid at central bank to raise interest rates by 25 bips above zero. Mm-hmm. And in Europe, with almost negative rates, some people are telling us that the solution is to lower interest rates. No? And so it's important that we think about the entire system by putting someone to blame. And this is what I explain in the book. You know, by creating these superhero type of enemies, we avoid thinking about the problems. So if we say, look, you know, it's very easy. The markets are to blame for the crisis. No, it's a great thing to say, you know, the markets. Why? First, because it's impossible to define the markets. What is the markets? You know, it's impossible. Second, it's foreign. It's away. You know, it's somewhere else. If we're in the UK, we blame the markets. It's on Wall Street. If it's in Spain, it's in London. If it's in Tokyo, it's in Wall Street. And if it's in Wall Street, it's in Tokyo. You always blame somebody that's foreign, which is great because it relieves us from responsibility. The second thing is that it relieves us from thinking, because you give supernormal powers to an alleged entity that works as a unity. So by doing that, we simplify the problem, we simplify the solution, and more importantly, we justify solving the problem with the same tools that led us to creating that problem. So the only thing that I tried to get as a message in this book is this is an environment that we're going to live in. We're not going to say, I refuse, you know. Stop the bus, I'm getting out. No, this is what we are. This is where we are. There's 27 central banks, increasing money supply, there's ultra low interest rates, we're going to continue to see very high levels of debt, we're going to continue to see a lot of boom and bust cycles. So what I try to tell each and every readers is, how can we benefit from that? And how can we avoid falling into the trap of being the last in the greater fool theory, the one that doesn't find one that does buy my asset more expensive than I bought it. And you know, at the end of the day, what I use is my personal experience to explain what are the best ways to avoid those traps without looking like some crazy lunatic that simply doesn't want to live in the world as it is. And because we cannot change those things. We cannot change those things. Even if we wanted to change those things, there is evidently, it's amazing what we're seeing, there is evidently a consensus among the population that what is wanted is even more. It's amazing what we see in Europe right now, how those radical parties that are coming that are becoming mainstream right now, what they're offering as a solution is hyper devaluations, lower interest rates, cheap credit, and money printing. So it's like, I mean, they're a dream come true for the evil speculators that they try to combat. And what comes as the most amazing thing is that we have learned to have a view about these economic and financial solutions to the problem that are based on religion, not on facts. It's pure religion. You know, you say, if we devalue the currency, we will export more. Okay, the Japanese devalue the currency, they don't export more. Well, it's because they didn't devalue enough. The Europeans, Europe was completely, it was getting out of the crisis through exports. They start to devalue the currency. What happens to exports? They collapse. It's because of something else, you know? Yeah, we enter into the realm of religion. We enter into the realm of religion in which we have decided collectively that the solution is that there has to be more credit. It's very interesting how political parties, financial commentators are talking about excess debt, and the solution is more debt. They're talking about how families are too indebted, and they're talking that the solution is that families get more credit. They're talking about the housing bubble, and everyone is begging for the recovery in housing. The recovery in housing means, and if you see the charts, that we had a 20% blip from an all-time high, and it goes further than that all-time high. It's a greater fool theory again, and we're all in it. So those things happen, and to understand the market at the end of the day, it's part of that, and that's what I try to convey in the book. The market is not just about being right. You can be right and you can be dead right. You can be right and say, look, I know, you can be right in 2005, I know that this is a disaster and the world is going down the drain, and you have 3 years of bull market. And you don't even live with a job to say I was right. So it's very important to be constantly monitoring sentiment, to be constantly monitoring when things are reaching breaking point, to constantly monitor what you're comfortable in terms of risk. Risk is not dictated by the fact that a bank or a government says that interest rates are negative. What happens in many societies in which the government lowers interest rates to try to avoid savers from leaving their money in deposits and put it into bonds or into equities, many times they just don't do it. Why? Because they don't have confidence. That doesn't mean. So the financial repression, which I mentioned in the book, which is lowering interest rate and devaluing the currency, does not necessarily create the outcome that the model tells you it will create. But we never complain about the model. We only say that something wasn't done either enough or for sufficient time. So basically, I hope that you enjoy it. It's very personal. There's lots of anecdotes. There's a little bit of everything, and there's a little bit of comments about the different funny and complicated things that happen in investing. But I think that ultimately, like any other environment, what we need to assess is how comfortable we are with risk, how big is our ability, how strong is our ability to sustain losses, what is happening around us that we're missing, how do we understand that what we're missing is relevant or irrelevant, and what I think is the most important thing, never to trust the advice of someone that has skin in the game to give you the greater fool theory, to pass you the greater fool theory onto you. And finally, the book goes through the different experiments that we have seen all over the world, what they have done to asset classes, what has happened with commodities, what has happened with stocks, how it's gone from euphoria to pessimism and then to euphoria again, and the best way to make a little bit of a sense of it all in an environment in which everybody seems to be crazy, but everybody seems to be in agreement that the ones that are pointing to the fire are wrong. So I hope you like the book, and obviously any questions, I would be very, very happy to take them.
Can anyone have any questions or comments? So I have, what's your view on the oil prices right now? How sustainable is it in the long term? Do you think it will be around this below $60, $70?
It's interesting what I read these days. Good afternoon. It's interesting what I read these days. I read the period, extremely low oil prices. Just a few years ago, oil prices were at $50 a barrel. When I came to the UK in 2004, 2005, oil prices were below $50 a barrel, 35, 40. So it's a very few years ago that oil prices were not that high. And so was, were U.S. producers going bankrupt because of it? Was Venezuela gone because of it? Was Russia in difficulties? We forget where we come from, and we forget that the industry is pro-cyclical. When things go up, costs go up, we become more sloppy, the industry spends more, service companies charge more, the producers spend in different areas with more risk. It's pretty much like the financial markets. And then oil prices come down. And then oil prices come down, and the industry is pro-cyclical as well. So how long can they stay? I don't know. What I do know is that the inflationary effect of monetary policy that created the super spike in commodities between 2009 and 2013 is not eternal. And that doesn't create, and that there's a point at which it becomes deflationary. Why? Because the Federal Reserve in the US is not printing money anymore and might increase interest rates. And the reserve currency, is the dollar. So commodities that are priced in dollars are not going to see huge inflation just because of that. But there's another thing, is that throughout the whole period in which we became the oil industry became very used to high oil prices, there was overinvestment. We went from a period of underinvestment in the early 90s to the early 2000s to a period of overinvesting. So what we have now is a lot of stuff that will have to be used because we've already spent money on it. So a lot of people will run, and you're seeing it already. You're seeing how quickly the industry comes down to much lower prices. The beginning of when oil prices went to 80, everyone was saying, shale oil producers cannot make money at $80 a barrel. Now everyone, the IEA and everybody else, knows that shale oil producers can still produce 88% of the production at $65 a barrel. You see how quickly things adapt. So it can last for a very, very, very long time. Why? Because we created overcapacity as well. No? So that's my main message. Disinflation is a very, very typical process after excess inflation that has created excess capex.
To ask what economic theorists you think sensible we should listen to? Is it the Austrian school and Ludwig von Mises and all those sorts of people, or is it more the Chicago school, Milton Friedman's and that sort of thing? What are your sort of fundamental principles come from on economics?
I think that to deny economic cycles is a big issue, and to understand economic cycles is a big lesson from the Austrian school of economics that I think is very much absent from academia, or from mainstream academia right now, because we try to justify globally that cycles can be turned through intervention, monetary policy, you name it. Okay, so to understand economic cycles to me is a key element that everyone at least should be aware of, even if you believe that being completely Austrian would create secondary issues for the population, you name it, blah, 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 blah. For the population, you always say, no, we cannot implement Austrian economics because it would create huge unemployment and poverty and all of this. If you had followed Austrian economics before creating bubbles, then you wouldn't have the issue of trying to sustain the bubbles afterwards, no? I think that Lord Keynes must be, shaking in his grave like the George Romero zombie, because what we are calling Keynesian economics today is just pure lunacy. I mean, one thing is that a government that has been saving, that doesn't have a balance sheet, and that is running a surplus, comes to invest in the economy in a time of crisis because the private sector is not interpreting the signals correctly and just comes to help. And another thing is that an ultra-levered government that runs a massive deficit comes and adds to an overcapacitized system just for the sake of it. So I always see that what we have is selective Keynesianism right now, which is that you completely forget, you actually burn the pages in which he recommends saving in the times in the good times and being prudent and lowering taxes. That's written off, and you only think about the spending. You only think about the spending and the deficit. And the poor guy, I mean, it's seriously unfair to him to have that perception. So one of the things that I mentioned is exactly that, is that, I think there's a lot of value in almost every school of economics. The problem is to be selective about it. It's like going to the doctor, and the doctor tells you should exercise, you should eat, with moderation, you should work a lot, and you could have a glass of wine with every meal, and you say, let's get some wine. That's the issue, is that the doctor order it. The doctor, bring the wine. So that is the problem of what we're seeing right now. You see in politics a lot of parties that are saying, look, this is recommended by Nobel Prize winners, and they recommended the last page. The last page that says maybe enter into a fiscal deficit. Yeah, not a 7% fiscal deficit, not an eternal fiscal deficit, not a So that I think that's the issue. I think that economists are being blamed for the malpractice of economic theory that governments put together.
Thank you.
If that helps.
That's good.
Just
I would like to know what's your opinion about the electronic money like Bitcoin, but not about from the point of view of use it to buy marijuana or some illegal things, but from the point of view because
To buy anything. To buy anything. Yeah?
I mean, it's I don't know if you know the algorithm, how the bitcoins are created, and it's more and more difficult to get more.
I actually
Bitcoin.
included in the book in English a chapter about Bitcoin because everybody was talking about Bitcoin as some sort of great solution to the disaster of fiat currency and the manipulation of currencies and currency wars and all of that. And it's not. And it is not. It is simply not. And it's not a currency. It's a financial instrument. It's way far from being a currency. I don't know if it could be a currency, but for something to be a currency, the first thing that has to be is relatively stable. If I have a currency that I buy today and it's down 70% tomorrow, believe me, imagine if it was used in 20% of the transactions of the world, the kind of crisis you would get. So that's the first one. The second one, obviously, is that currency is not just a means of payment. There is a social value of currency. There is a social means for currency. So when there is no social mean, it's just a store of value, then it's a financial instrument. And it's a store of value if you think the greater fool theory. If you think that somebody else is going to buy my bitcoins and while I mine, the supply is going to be higher than demand, etc. But that's a financial instrument. Think about an economy in which you had that situation, and you had the completely, say 50% of the economy was using that. The supply is limited, but the demand is not limited. So you have a very big problem because supply demand is not generated by economic activity. It's generated by perception of value, and it's a big difference. It's a big difference that you and I, we sell things to each other, we create businesses, etc., and that creates a GDP and creates economic activity. Then the fact that I think that this book is worth £20 and you think it's worth 24, that is a huge difference. Okay?
Yes, just to mention, as regards to the debt issue that you mentioned, the fact that interest rates continue to be low, except of course in places like Russia where it have spiked, of course, doesn't this suggest that people don't perceive risk in the debt economies that we've got now in the UK, US and places like that?
Well,
is it connected to the fact that asset values are keeping high, like property values have risen up in certain places, which gives people a different perception of risk, a feeling of security or comfort? So I'm trying to link this into what's happening in the property market as well, although it's obviously changing now in the UK, or what we think might happen to it.
okay,
onwards.
I mean, the property market is supply and demand, and at the same time it's perception of access to credit. Because nobody, or very few people, buy property based on owning 100% of the value of the property. You will gear up, and it's probably the most levered investment that you will get into. Even if you buy a car, your down payment is likely to be much higher relative to the total value than the down payment that you put on a house. Okay, so perception of availability of credit is a very, very important factor. Low interest rates mask risk. They do.
Yes.
They do. But low interest rates are not the function of people believing that risk is low. Interest rates are not created, are not set by people. They're set by governments. Okay, so governments want to incentivize confidence by lowering interest rates, by keeping interest rates low.
Look, the differential between base rate and rate charge can be elastic.
Exactly. And that tells you a lot about the real perception of risk. The fact that you have 0% interest rates at the base rate, and small and medium enterprise is charged maybe 10% to set up its business. Why is that different? It's because the bank is greedy, which is what I read when I was waiting for you to start. It's because the bank is greedy and wants to overcharge the small and medium enterprise, and is very evil and doesn't want the economy to get better, seriously? Or is it because the likelihood of earnings growth to be as expected by the company is very limited? The sales growth is probably going to be pedestrian, and the margins are going to be very tight because there's overcapacity. Is the bank really, does a bank whose job is to lend and to make money not want to lend cheap money to good companies to make a good profit or a good return out of that investment? Of course not. You see, we're blaming the waiter, as I say in the book, we're blaming the waiter for the evils of the chef. But why would the waiter not serve you the food if it's there and you want it? Well, it's maybe because you can't pay for it. Huh? So I think that that perception of risk, therefore, what very low interest rates do, and at the same time the confidence about capex, about investing in the economy, the confidence about the viability of the real economy of businesses is poor. What zero interest rates do is that big increase in creation of money goes to liquid financial assets. What would you do? Imagine that I give you money and you have to lend it to any one of us here, and you don't trust. I'm sorry about that, but you don't trust anyone to give the money back to you. What do? You go to the bank and put it in shares, or put it in bonds, or put it in. That's when you expand money supply and you lower interest rate, you try to create a level of confidence that the real economy does not pick up. And that's why velocity of money, as I explain in the book, collapses, despite the fact that you are increasing money supply and there's low interest rates. Why, with the economy in the US growing 3%, capital expenditure from the S&P 500 companies does not grow? Why do they buy back shares and increase the dividend instead of investing in the economy? The economy is growing 3%. Why don't they do it?
So could we think that low interest rates are like masking risk in the sense that they're driving up asset values?
Of course.
Property and so on.
Of course.
So you don't see the risk until the asset price tanks.
Until the asset price tanks. Exactly. So as long as the asset price doesn't tank, what you are expecting is that in an overly geared economy, those assets will be worth something, somebody will buy them, companies will become less levered, families will become less levered. It's called the perception of wealth, all those things. So what you try is to normalize the process of interaction within the economy. But there's a point in which it becomes a self-fulfilling prophecy, in which you, instead of aiding an abnormal asset mispricing, you're in a financial crisis, everything is collapsing, nothing makes sense, good businesses are worth almost zero, no one can get credit, so you do that, okay? And then, instead of aiding the process to get out of the problem, what you become is the problem, because you get to a point in which the economy cannot function properly unless asset prices continue to go up. You understand? So what's the issue? So the solution for a crisis by being cautious and they call it dovish, no? Yeah? By being dovish about the solution and hoping that things get better and maintaining super easing policies, what you end up becoming is part of the problem. I mean, you know, that's a huge issue, no?
And I have to disagree with you about the banks. You say if they can make money by making good loans, why wouldn't they?
Yeah.
There's an answer for that,
Yeah.
which is that skill has died. Then current bankers lack the ability to look at a small, medium company and judge whether it will pay its debt back. What they can do, and have been trained to do, is to see whether they can chop the debt up, mix it around, sell it on to somebody else.
Exactly.
And that is what they've been taught is banking. And until we get back to the days when a banker can look at an individual loan and judge whether it's good or not, it's difficult to see how we're going to go anywhere.
And
I think that's going to take 20 years if we start now and they're not starting now.
Now, let me put it the other way around. So, imagine, let's assume that your view is correct. So, they have been taught to do that. However, that creates big systemic problems for them as a professional. Today, you know, and we're not talking 2008, okay? That is, so today, if you are one of those bankers and you try and you start to package things and all that stuff and everything, I mean, you have everyone and everybody looking at you, okay? So there's not a professional incentive to do it. So what is the incentive to not do what you're saying? The incentive not to do what you're saying is the fact that the price signal is incorrect. So if I tell you that interest rates are 0 and that money supply is growing at 3 times or 2 times the nominal growth of the economy, okay? Do you, as a person, think that those price signals, which are at the end of the day interest rates, are price signals? They tell you whether there's risk or there's no risk. But if I am manipulating the interest rate or lowering the interest rate too much, you say, look, you know, I don't trust it. It's an incentive on the price signal. The price signal, which is money supply and interest rate, forces you as a professional to look for alternatives that are liquid and easy to get out of. Let me put it this way. You are that same professional. You have the current environment and you have lending to companies, okay? Lending to SMEs, or buying bonds of sovereign countries that you know the central bank will buy back. What do? You know, you, not the banker. You as a professional, you arrive today in a bank, you are the owner of the bank. What do you do? I'm sorry, I know that you would love to say I would lend to the companies, you would buy the bonds.
I would do whatever all the other banks are doing. I haven't tried.
Very good answer. But you have a very good answer. That's a very good answer, actually. That's a very good point. What does the rest of the banking system do? The rest of the banking system, all of the banking system does, is react to the incentives and the penalties that the regulation puts on them. So let me show you, for example, what has happened in Europe. In Europe, everybody complains about the transmission mechanism of monetary policy to the real economy. It's incredible that there's 189 billion of excess liquidity in the system, yet SMEs don't get credit. Okay, and if they get it, they get 10%. Yet, regulation tells you, and this is in European regulation, that if you lend money to a government, no matter how indebted it is, no matter what deficit it has, no matter what fiscal revenues they get or how much they spend, it tells you there's no risk. The regulation tells you there is no risk and tells you that the amount of capital that you need to have to lend to that government is very limited. Yet, to avoid risk, it tells you that the amount of capital that you need to lend to your company, this is a regulation, not the bankers, is 3 times more. What is this regulation telling you? Dude, come over here and buy some government bonds. So, what
Well, no, there's a price at which it's worth doing that. But the
What?
price is probably 10% for a decent small to medium-sized enterprise, 20% for the ones who actually want to borrow, because the well-run small to medium-sized
they don't
enterprises
need to borrow.
are just throwing off cash and they don't want
They
to
don't.
reinvest it because
And they
the
don't.
interest rate situation is so screwed up that there's no
And they
there's
don't
no long-term price signal coming in. Yeah,
But you're absolutely right. But if you but to go back to the point of the evil banker or the evil speculator, the incentives that are coming to you from government monetary policy, interest rates, money supply, plus regulation, don't enforce, don't support what you're telling me. It's not that they're bad. I mean, and you know, more importantly, if there was such a gap in the market based on the fact that there's incompetent professionals in the system, believe me, it would take a year before the competent professionals would come in and take a gap of that market. It's very simple. You go up, you buy a license from a UK bank, and between us, and we leverage 5 times, and we invest in the real economy. So I think that there is more to that than just being lazy about easy money. It is not incorrect what you're saying, but it's not the entire picture. And the reason why it's not the entire picture is very simple. You can think of that, of the banking system that is fully private, quoted, needs to give quarterly results, pay a dividend, you name it. But why doesn't the state-owned and semi-state-owned financial system do the opposite? They don't have the incentive that you mentioned. They don't have the incentive to make a quick buck. They don't get bonuses. They don't get big cars or Ferraris in February. So what
They do here.
Sorry?
They do here.
They do everywhere. They do everywhere. But what I'm saying is that in all of the financial system is not even half of it is private quoted investment banks with huge bonuses and big incentives to make a quick buck. It's actually more than half of the financial system in the world is state-owned or semi-state-owned. So there's a flaw in the theory that which is an issue is the issue.
My point was you can fix the incentives tomorrow. It won't be done, but you could. But I think it will still take a very long time to fix the people who have grown up in the old world, well, in the new world.
Well, let's be honest as well. Let's look at then the solution. Then the solution would be Europe and not the problem, because in Europe, what you have is a banking system in which the managers and the big managers and the big guys have been here forever. They're forever. I mean, we're talking about 65, 70-year-old people, not 25-year-old guys trading copper against coffee. And they're not doing it. So, yeah, you have a point. But the point comes from the incentives, and changing the incentives doesn't change when the price signals are incorrect. That's what makes me find it, and it's actually mentioned in the book. Is if that is like that, why isn't why wasn't Spain or Italy or Portugal, that had 70% of its banking system in semi-state-owned entities, rock the world? They're actually the worst. I mean, the worst. They're actually in as much trouble as everybody else, or as much debt problems, no?
Just to ask
Hello?
Just him first, yeah?
Yeah, just a question in your book or in your career in general. Have you spent much time analyzing industries which become extinct or could become extinct over time? I mean, we talked about the energy sector a little bit earlier, and there's a lot of commentators today who do talk about, especially big oil companies, for example, potentially, basically becoming extinct because they might not be able to adapt their business model, or you look at fixed line telecoms, for example. Is that something you've been looking at in your career?
I look at everything that goes down these days, my friend. What are you talking about? I look at utilities and big industrial companies and oil companies. Of course I do. There's a trap in your argument. The trap is to think that those businesses don't survive or become extinct. They might be different. There might be a lower multiple that you attach to that business instead of, it's not a growth business. I don't think that anyone by now assumes that the oil industry is a growth industry. But there's a lot of cash. Maybe it's a dividend industry. Maybe it's an industry that doesn't need to invest as much and pay very big dividends and shrink to improve. No? So what I'm trying to say is that the concept of extinct business is Malthusian, no? Is assuming that things just abruptly end. No, businesses change. If you would tell me, 7 years ago, that Germany's largest utility company was going to spin off its transmission assets and separate the underperforming, declining assets from the ones that actually are growing and their stable returns and good dividends, etc. I would say you're crazy. So companies change, and managers change as well. No? I don't remember who said that, but the famous words about the rumors of my demise are greatly exaggerated. Is something that we've seen in big oil and big utilities and big telecoms for a very long time. For a very, very long time. Will they exist the same way in 100 years' time? I don't know. I read the other day that 50% of the S&P 500 has less than 30 years of existence or something like that. No? But it changes dramatically. A good friend of mine has a presentation debunking Piketty's book, and he shows the biggest capitalization companies and the richest people in 1987, and the top 35 don't exist. Are not there. We don't even know who they were. Actually, obviously there were a few Japanese there, because of the big housing bubble. So yes, of course, businesses adapt, but there's a multiple for everything. There's a multiple for zero growth. I don't have a problem with zero growth. I don't have a problem with zero growth as long as the company is not delusional about its growth as a concept. No.
Question. Just to ask you, as far as the oil is concerned, people talk a lot about Russia, but what about other parts of the world, like the Middle East and Saudi and places like this? There don't seem to be so much furore about the impact on other countries. And secondly, was there much indications that this might happen? It happens all quite relatively suddenly, and people are talking about it after the event.
Everything happens,
before the event. And the thing too about this country is the big reason that probably might be property, because property has escalated in value.
Going back to property, yes, maybe, I think at the end of the day, it's risk-adjusted returns. You know, if you buy yourself, to be fairly honest, if you buy yourself a home because you're going to live in it and raise your children in it and you're going to fill it with IKEA furniture and live the dream, what do you care if it's 20% lower as long as you can afford the mortgage? Why do you care, seriously? The only one that cares is the one that wants to double up and go higher by, you know, through leverage. That's a different game. Perfectly valid. I'm not questioning it, but you know, I don't know. The key is I don't know. The question is what. The question is not whether the absolute price is going to go up or down. Because, you know, I know a lot of people that bought. I actually have a friend that calls the peak. It's a very valuable friend to have. Calls the peak on almost every asset class. Calls me and says, Daniel, the IBEX is going through the roof and fell 17% in a week. That, you know, beautiful. So what I'm trying to say is, and this guy bought his property, I think literally the week before it collapsed. But what I'm trying to say is that, does he have a problem? No, because he could afford it. He can afford it. He could afford it. It's a risk-adjusted investment that doesn't create a problem. Now, oil prices. Well, oil prices are very much the same. You know, everybody talks about the oil price that OPEC needs to balance the budget, which is the most ridiculous figure I've heard in my life, because it's the same as saying, what is the salary I need to keep my standard of living? That doesn't mean that I'm going to get paid that. You know, there's a lot of slack in OPEC budgets. Everybody was telling me the other day, Venezuela's going bankrupt. No. Did Venezuela go bankrupt? No. They stopped giving oil for free to the friendly political countries that end the problem. You stop putting 11.5 billion of subsidies from PDVSA's balance sheet into God knows where, and ends the problem. You know what I mean? Is that it's not about the absolute price, it's about your risk-adjusted return and your ability to function at the mid part of the cycle. So I would avoid looking at absolute prices as a signal, because I am 100% sure that a very rich guy that buys his home with no debt, only equity, at the peak of the market, sincerely doesn't care if house prices fall 30% or 40%, unless he was expecting to make it an investment. Okay, that's the difference. No?
You have more time for one question, comment, anyone else?
Are you able to say anything with regards to the gold prices, the way they have been going up over the last few years? Are you in a position to share your views about
gold,
that?
again, you have to differentiate. You have to differentiate gold as an inflation hedge, as a financial asset trying to offset currency devaluation impacts, etc., from physical gold and supply and demand. And I think it's exactly what we've been talking about throughout. Is when it becomes a tool to hedge something or to justify something. If that premise doesn't happen, if you bought gold because you thought that there was going to be hyperinflation from increase of money supply, and then there's no hyperinflation, you know, the thesis becomes wrong. That's the issue. So as long as you know, the other day was with gold prices this low. I heard the other day. What do you mean this low? What do you mean this low? They've gone from 250 to 1650 down to 1250, and you know, you see that? You see what I'm trying to say? It's what we were talking about, the oil price. With oil prices this low, gosh, they've gone from, I remember I started in the oil industry with oil prices at $10 a barrel. At 10, no one was making any money. Not one. No one. I remember, unfortunately, when the Iran-Iraq war started, that's, suddenly people started to breathe, unfortunately, that you started to see oil prices to go up. So what I'm trying to say is that asset price itself does not say anything, especially because you don't know exactly what created the spike in the first place. If it was, and I actually do think that a lot of it was based on the fear of hyperinflation. Then hyperinflation didn't happen because, a lot of economists are starting to look at the effects of extreme easing, and instead of showing that it's hyperinflation, what it does is create inflation in financial assets, and it doesn't create inflation in the real economy. So it's a different parameter, it's a different thesis for your investment.
Thank you very much.
Hi, Daniel Lacalle. It's a real pleasure to meet you. I hope you will sign my book later.
Ah, well, yeah.
Perfect.
If you bought it, yes. If you stole it, no.
I will not answer that. First, I hope you will come back to Spain to La Sexta Noche to have another chat with Pablo Iglesias soon.
I don't think that's in my hand. But anyway, go ahead.
I would really like to know, in Spain, 2015, oil price, they suppose quantitative easing can happen in January, and the lowering of the tax in Spain. All the elements that are now on the table, what do you think will happen at the end of 2015?
Gosh, if I knew what would happen at the end of 2015, I'd put the bet today, go on holidays, and come back. I know a few things that you can know. Spain is extremely levered to oil prices. It imports about 1 million barrels a day of crude. So obviously, this is a huge boost to the economy. It's about 1% of GDP. $10 a barrel fall is about 10% of GDP. So it's about 1%, $10 a barrel, 1% of GDP for a sustained period of time. It's a huge boost for an economy that was growing 1.4% this year. So it's obviously very, very positive. Quantitative easing in the crazy form of 2008 brought Spain down to its knees. Because we were building airports and all this stuff. I don't know what we're going to do with the Juncker plan, but to me the Juncker plan looks like a huge problem, again, of doing the same thing that we did in 2008 in Europe. But there's tailwinds on the Spanish economy, and I'm super happy, and I really hope that the Spanish economy will get 450,000 new jobs next year, and you start to see a little bit of party after the pain.
Daniel, thank you very much.
Thank you so much.
Thank
Hope you like the police.
I would like to make a last remark. Daniel's publisher, really, he kindly shared with us a discount we have, each one of you have. We would like to